Hello, Saul. Hello. Hello, all. Thank you for joining us today. Taking the automobile sector, for instance, let's look at the 21 quarter margin trends of Bajaj Auto. While gross margins have gone up by a meager 40 basis points, the EBITDA margins have secured a 180 basis points growth. This clearly reflects an improving operating efficiency. This improvement in operating efficiency has been reflected through more than several instances in the corporate India. So today we have Mr. Balaji GR, Head of Research and Co-Fund Manager, who will take you through the different elements of corporate India that reflects growth and success. Without wasting any more time, I'll pass over the podium to Balaji, sir. Thank you.
Hey, thanks, Tarun. A very good morning to all for joining on a wonderful Saturday. The whole idea behind running the session is every last couple of quarters, what we have been rigorously doing as a team is once the corporate results are out, which typically ends on 15th of the second month of the quarter, we want to put out a good document which talks about how corporate is behaving, how their balance sheets, because this is a September results quarter where the balance sheets have been disclosed, how the cash flow has been improved. Because finally, with corporates, right? Well-run blue chips, large, mid, and small caps. So which is corporate India. So that's where this series got started a couple of quarters back, and we are very happy to come back with yet another series of corporate India, how they are performing, taking a note on September 2023 as a stock. So if you look at the broad things which I'll be covering over the next 40 to 45 minutes, then we will take the question. The first one is the mega trend which is getting captured at the India level and obviously at the corporate India level. The commentary of the corporate India, how the numbers are played out, just ended September results. And obviously, right, how does the macro setup and where the opportunity lies? So this is the broad construct of the entire session is going to be. Moving on to the next, what's a mega trend of corporate India? Before getting into corporate India, the biggest mega trend for all of us, which we really take fruits is India, right? India itself is it's about say a large cap stock type where consistently be growing not for 1 year, 2 year, for last 20, 30 odd years, right? We have been having a very steady growth. To put in perspective, during 2001, 2002, India's GDP alone is only 38 lakh crores. And around 1 decade back, our GDP was 87 lakh crores. And today we are talking about just maybe another 4-5 months out there. Our expected GDP end number should be anywhere close to 300 lakh crores as an economy, right? And then obviously, right, the picture what we all want to envisage is 38 moving to 87, 87 moving to 3. What this 3 could be, right? 3 could be a 7, 8, 9. Obviously, right? We are not here to forecast, but we clearly know the path is India is going to be a much larger economy in next 8-10 years. And how, as an allocator of capital, how we see this big picture. And given the evidence, right? 22 years CAGR of India GDP growth is 10%. So keep this number 10%, a very important number from an Indian context where companies growing above this threshold gets a lot of attraction. And that's what we end up seeing it, right? Company having a slow growth phase for 5-6 years, around 6-7%. And when they move into a growth phase of 14-15, right? Suddenly a lot of attention. So as an allocator of capital, our endeavor is to find companies which is going to capture the best of growth from 300 lakh crore economy to a 600 lakh or a 800 lakh crore economy, right? So that's our endeavor. Moving on to the next, right? Having seen India has grown at 10%. The another number which as an investor we should be definitely cognizant is how does India growth getting reflected in earnings, right? So there are many countries where GDP growth continue to be very big. We have seen our neighbor country which did extremely well in terms of GDP for last 20 to 20 years. But from a market point of view, they are not able to deliver sustainable value because finally GDP translate into sustainable corporate profit and rewards to the shareholder. That's where the markets also will get rewarded. In the Indian context, 20 years, broadly in line with what the GDP, right? Nifty earnings have grown between 12 to 13%, which is again a very true statement. And very beautifully, the entire fundamentals is also getting reflected in the market, where the markets have grown at 13 to 14% CAGR, right? So in the long term, markets have delivered between 12 to 14% CAGR over a very long period. Again, this number, I want all our investors, prospective clients to think about it, because today we are in an extremely buoyant phase. Last 1 2 years, right? The couple of 1 year return, 2 year return is upward of 40 50, right? So these are periods where market tend to reward more than what maybe the fundamentals. There will be periods where market tend to not reward even though fundamentals are good. So I think broad return expectation from an India point should be around this 13% in and out between like 12 to 14 is a very good range to think in the long term. Having seen how India growth has been done for last 20 years, how earnings growth for the bigger index has done, for us, corporate India, primarily we refer to BSE 500. And the one question can come up to all of our mind, right, Balaji? Why we think BSE 500 is a good representative? So one of the way to think about is, if you look at BSE, by capturing BSE 500 numbers, which is only 500 out of 5,000 odd stocks, we are capturing 90% of the market, right? So what we are actually not going to cover is the 10% of the market beyond BSE 500. Obviously, it has very relevant for some context. But to get a big picture, BSE 500 is a very good landscape, even though NSE 500 or BSE 500 both gives you a very good landscape of what is happening with corporate India, because they cover 90% of the entire value created by the corporate India. So how does value got created, or how does the value getting created in India? This is one of the very important data as capital of allocators we keep thinking and seeing, right? So all corporates put together, which is again BSE 500, when I refer all corporates in this context, has invested 77 lakh crores of money, right? This is only equity capital. Obviously, they do have debt capital. This 77 lakh crores of equity capital, which is all the shareholders' money, resulted in, on a TTM basis, 12-month trailing 12-month, corporate India has delivered 140 lakh crores of sales. 140 lakh crores of sales with a 9% of a margin, roughly, right? Corporate India makes, we have done close to 13 lakh crores of profit. So corporate India on every single year currently on a 12-month basis, delivering between 12.5 to 13 lakh crores. In the 13 lakh crores, during last year ended FY23, corporate India has paid out roughly 4.16 lakh crores in the both in the form of dividend and buyback. And if you look at return on equity, right, finally, is corporates are creating value, right? Clearly for a 77 lakh crores, if you deliver 13 lakh crores, right, your return on equity is roughly close to 17%. And since we are paying out 1/3, right, we are retaining 66%. The sustainable growth of corporate India, if I just remove the payout, which will be like out of 13 lakhs, we remove 4 lakh, we will retain 9 lakhs. And given 9 lakhs with 16 to 17% ROE, I think corporate India is well poised to grow between 11 to 12% sustainably. And you have seen in the long-term return of Nifty is also 12 to 13, right? So clearly the value is getting created where corporate is deploying equity capital, resulting in sales, sales resulting in profit, profit then payout to the shareholders, and then retaining a very good portion, and then investing prudently in a good projects, which is earning between 15 to 17%. Obviously, this number is not a static number. This is a slightly a cyclical number. But broadly, I think corporate India endeavor to put capital around 15%, given our cost of equity. So clearly, our corporate India is creating value. They're not doing business just for the sake of business. Okay, having seen this 140 lakh crores of a sales, right? Where does the big money spend? And this is the first time we are putting out this data because after we started this series, the annual reports have come till September ending for all the companies. And this is the first occasion where we have the opportunity to showcase where corporate India have spent money on FY23 basis. So salaries and wage, which is one of the largest component, corporate India has paid out close to 11.54 lakh crores of money to all the employees put together in BSE 500. The long-term trend is 12% CAGR, slightly faster. But interestingly, in the last 2 years, salary hike have been little more faster, right? Close to 15%. Also clearly reflecting reflecting the wage hike pressure which we saw it's been in a trend of 10 to 12% growth over a very long period of a time. And typically, it's like a 9% of your P&L, right? Corporate India pays as an employee. So, as an employee cost, obviously, a few companies who are people oriented, employee cost could be very varied, but broadly 9 to 10% for a good management application. One another item which I thought it's very interesting to see is a marketing expense was very stagnant till some period. And in the last 2 years, suddenly you're seeing extreme acceleration in line economy, right? So the long-term trend of marketing expense is close to 8%. But if you look at again last 2 years, right, it's been phenomenally 25%, right? Clearly reflect corporate, and they are also trying to invest back into the market to get the demand up. Third, very interesting in terms, one of the questions keep coming up to all our thoughts is corporate is putting capex, because we are very clear that government is putting a lot of capex, which is central government. Now state government is also putting a good amount of capex. Definitely individuals is putting large capex in real estate. We are seeing extremely strong, I want to say pre-sales booking for a lot of corporates, which is getting disclosed. But if you look at fixed asset addition, right, corporate data typically end up doing 5 lakh crores, right? So you end up generating 8 to 9 lakh crores of profit, which was in 18-19, and you put up 4 to 5 lakh crores of capex. But in the last 2 years, steadily, if you see, it's moved to close to 7 lakh crores of a capex. Clearly, we are seeing the acceleration. So last 2 years, again, the capacity addition is 20% CAGR growth vis-a-vis the normal trend of 8%. We have to see whether this addition is a function of relatively they invested less during COVID period. Is it a catch up of that, or is it a bigger trend towards investing more capacity today so that you can capture bigger demand? As Tarun started in the beginning, right, one of the sector where we're clearly seeing evidence about capex coming after a very long time is in auto. Put in perspective, Toyota is going to come up with third plant. The second plant came in 2010, right? So clearly, if you see after 13, 14-year odd period, the MNC giant is again coming like faith about sustained. And that's where I think after a long time, the projects are coming up. So it's a very interesting phase. And the last data, which I thought it's very again interesting, right? Why industrial credit is not growing? One question which keep coming up when you look at the banking results, right? So if you look at banking results, it's primarily the growth is coming from retail. Retail loans are growing at a phenomenal pace. Finally, RBI took a decisive call to add the risk weights to slow down the pace. There is a growth being there in personal retail, every part of the retail, a bit of SME. It was a very anemic growth of 5 to 6% in corporates. One of the reason again is corporates today sitting with a lot of cash. To put in perspective, 5 years back, 6 years back, the aggregate cash position, which is basically short-term investments in bank, FD, bonds, whatever, right? All the investments which they're carrying the balance sheet used to be 10 lakh crores. And today, close to 17 lakh crores of the capital is sitting primarily at various corporates at various heads of treasury, right? So one, there is a big treasury income happening to corporates. And second, they are already have sufficient capital. So what does this brings to us, right? From the first leg of capex, I think corporates are going to use a lot of their internal cash flow, the balance sheet cash which they carry, which is the 17 lakh crores at aggregate. Second, every year they generate 13 lakh crores, they pay out 5 lakh crores, they retain 8 lakh crores, right? So you have an 7 lakh crores of capital generated every year. You're sitting with a 17 lakh crores. So apart from this exhaustion is where you will slowly and steadily will see the industrial credit picking up. And that's also getting reflected, right? Last 2 years, slowly as the investment picked up, the cash balance growth is slowing down. And obviously, corporate India is also paying out more. So clearly, corporate India is using the balance sheet to prepare for a very longer growth. That's why we believe as a house, this 4 5 years of a phase is going to be extremely good phase where both banking balance sheet is extremely clean and corporate balance sheet is flooded with a lot of cash, right? So they both are in extremely good position to capture capture India growth. I think that's someone substance which I would like to share. So having seen India growth, how does Nifty have grown? And we have seen how the corporate balance sheet, how the corporate performance has been happening. Let's see what's the commentary of corporate on three bigger aspects. One on the economy. Second, two pain points I would like to touch. One is rural India and one is exports. So if you look at economy, right, fantastic commentary. It's coming across the board. We just taken two large banking companies out of top 50 names, which is very large. They represent India much better, right? So if you look at Axis Bank, clearly talking about India's story remains strong and intact in spite of very volatile global environment. We clearly see, and upcoming festival season, we are already seeing a surge in demand. I'm sure we all have read a two-wheeler had a very good sales, and a few other industry came back very strongly during this extreme festive season for India, right? So typically starting October, November, right? These are the 2 months where a lot of business gets underlyingly strong demand because of a lot of festive season. So that mood is getting reflected even in the banking commentary. And very similar coming terms of from ICICI also, right? If you look at underlying growth momentum is visible. Service PMI, real estate buoyancy has come back very strongly after a long period of time. If you look at steel demand, right, typically India is currently going through a nation building phase. The volume demand for the steel is close to 12 to 13%. Clearly, underlying infrastructure growth, so reflecting in cement growth, right? If you look at ultra tech volume growth is upward of 12, 14%, clearly reflecting. And the travel demand, right? So the government continued. So at an aggregate, the commentary on economy is extremely robust. Why it is very important to discuss this is since we are in an environment where the global news is not very favorable, both from growth and interest rate, we need to clearly think about where are we investing. We are finally investing into well-managed Indian company operating where they do predominant business in India. Few companies obviously do business globally. Given that construct, we should know what's happening in India, and that's where I thought it's important what our corporate leaders, right, the CEOs are commenting during the con call, right? We thought we'll capture and share it to you. A very strong commentary on the economy. Coming to rural, right? I think this has been a pain point. I think it'll going to be a little more longer, but this also can turn to be an opportunity. So the pain point is volume recovery is very, very gradual due to high inflation. I think HUL and no better stock to reflect what's happening at the rural economy because HUL is actually part of every household, right? There will not be any household where HUL products are not present. So it's very important to see what's a bigger commentary. But what they also believe is more disposable as the inflation gets tapered down. If you look at almost all FMCG company, the commentary is very similar. Volume growth is okay, but the value growth is bad because they are actually passing on the disinflation. So what HUL also believes is at some point in time, the disposable income will grow and that will help all of them to revive, right? That's from a HUL commentary. And if you look at Britannia, a very similar commentary. There is a slowdown as far as FMCG is concerned. What we are seeing is a clear slowdown in the rural. So I think this evidence of rural slowdown is getting deeper. But very interestingly, right, few companies are trying to handle the slowdown in a slightly rural is something what we can counter with our distribution growth, which will continue, right? So many company, what we are seeing both in our portfolio level at the aggregate level, right? They are speeding up in terms of the distribution growth to catch up the current slowdown. And as with what they believe in is as the economy stabilizes and comes back, right, from high inflation to a low to a moderate to low, the demand will come up and the infrastructure what they create during this period will help us them to capture it. So clearly, as of now, the pain point is rural, definitely, but the opportunity next 2, 3 years is going to be also coming up from this space. And we are also clearly seeing the first sign of shootout again, at least in the Diwali period or during this festive period, two-wheeler had a very good demand. That's also getting reflected where almost all two-wheeler company either at today trading at either 52-week high or all-time high, clearly reflecting the underlying mood is slowly changing for better. Look at Global commentary again, right? So there are two pain points which can turn opportunity. One is rural, one is global. Again, Bajaj Auto clearly a company out of India, a very good manufacturing excellence company doing very well. Also talking about how world economy is shaken out due to this macro concern. One of the very peculiar concern in a few of the countries which Indian two-wheeler operate is the forex availability was less due to tightening of the dollar perspective. Also believe is slowly things are getting normalized from growth point availability of even the currency. Similarly, if you look at agrochemical companies have reported very bad numbers, primarily due to destocking and elevated pricing pressure, which we are also seeing the commentary of UPL. So in sum and substance, if you have to see, Indian economy is doing extremely well. A very small pockets of Indian economy, which is part of the rural sub-segments, which is slightly not in a great place. They're not in stress because if they are in stress, it will have shown up lot things into microfinance or an NBFC where the numbers are pretty robust, but definitely the demand is slightly suboptimum, and globally also the demand is slightly suboptimal. But next 2 years, I think this is going to be the window where, as they come back, the will get far more broad-based, and there are a lot of opportunity will indicators. So having spoken about the bigger trends, the commentary, now let's get into what's happened to corporate India. How did corporate India perform just ending September 2023? First, sales, right? The foremost. So I've shared the aggregate corporate India. So for this quarter, corporate India has delivered lakh crore sales, growing at this on face of it look, but if you look at some sub-sectors like oil sector, which is one of the largest, 33% of sales, oil constitute 10 lakh crores of our sales. They are down by 10% due to oil price have corrected from last year to this year. So if you remove that, I think corporate India did between 8 to 9% of a sales growth. So that's a first number at aggregate. But very interestingly, one of the argument which keep coming up when generally we're to talk about every segment is growing is no, small cap tend to grow faster because they are small in scale. But if you look at data, right, the data is not collaborating with this entire narration. Large caps have grown at 5%, mid caps have grown at 6%, small caps have grown at 4%, right? Obviously, the data doesn't support a very easy argument of small company tend to grow faster, larger company doesn't grow faster. I think this is more than the number. The numbers are talking slightly different picture. In generally, we agree with the view where a very specific portion of a small companies can grow faster than an economy because their size is small, the opportunity set could be large. But if you look at the aggregate picture, right, a very all companies put together, this narration doesn't hold good. I think as long as economy is doing good, you will see a very efficient large cap is also growing very consistently 15-20%, right? No other better example than Titan, which is a 3 lakh crore economy, a 3 lakh crore market cap company doing extremely well. And you just see the results for last couple of years, right? They're consistently growing at least 5 to 7% more than India GDP growth. So I think growth is slightly subdued to the extent of 2%, not to the extent of 5% as the number suggests. As I told, oil companies have gone through a price correction-led sales growth, degrowth. So if I double click this entire segment, right, here is a right? 34 lakh crores crude oil company rated sales is down 9%. So this is where that 1 lakh crores of a sales down is happening. Banking did a very good growth. Automobile came with a very good growth. Again, if you look at iron and steel, right, primarily there has been a volume growth, but there is a price correction. That's where it's a very subdued. NBFC had a very good growth. Power had a very good growth. Chemical is one segment, right, where genuinely there is a demand pressure and the price pressure, which we are seeing in the stock, and the numbers are getting very reflected. And otherwise, the broadly infrastructure companies did extremely well, around 18% growth, right? So if you look at clearly, all the cyclical piece did very well, barring oil because of price correction, metals because of price correction, and chemicals because of price and demand. But if you look at non-cyclical, right, that's where interesting, right? So a very strong company like an IT industry, right, has slightly seeing a subdued growth in line with the commentary that global economy is slowing down. So they have grown close to 7%. FMCG has grown aggregately at 0, but again, there are two as distorted reported this data. One is Patanjali and one is Adani Wilmar. If you remove this data, or typically FMCG's companies have grown between 7 to 8%. Healthcare did extremely well, very strong double-digit 14% growth. And if you again double click on healthcare, the growth came from company not only domestic focused, the growth also came from company which has a global exposure, particularly in US, where off late you are seeing pricing pressure has been slightly less and demand environment is stable. So we are able to see a very good uptick in growth in healthcare segment. And alcohol, obviously, right, is slightly subdued. One company sold off some portion of business, so that data is slightly, what to say, skewed. But broadly, 7 to 8% is what non-cyclical did. Cyclical did better in terms of growth angle because economy is doing extremely well, right? So having seen the sales growth, this entire result season is all about margin expansion. As again Tarun alluded in the beginning, right? We are seeing margin expansion happen a multiple industry, multiple sector, multiple stocks, and I think the numbers are clearly reflecting. If you look at large caps of at aggregate, corporate India have delivered 3.4 lakh crores approximately with a 40% of a growth. Again, this 40% looks very, very elevated given what we have grown. But in this 40%, close to at least 30,000, 40,000 crores of profit is coming from OMC company, which reported during last year very subdued numbers. So if you remove this, I think broadly corporate India delivered between 20 to 25% sort of a growth. So if you remove the extraordinary numbers, corporate India aggregately did 8 to 9% of a growth between and 20% of a growth at the PAT level. So that's a big picture. But if I don't remove all this, right, because at the end of the day, we have to see the full picture. Large caps again grown at 37%, mid cap 57, small cap 32 on terms of growth, right? Again, reflecting the similar trend. Small cap tend to grow faster than the mid cap and mid cap tend to grow faster than the large cap. But in this case, at least mid caps did pretty little more better than both other subsegments. But broadly, the healthy trend is every segment is growing. So this is the best part for us, right? If you are an investor who have already invested, right? Corporate India is delivering numbers. The rise of the market has two components today. There is definitely a fundamental component. In few of the segment, definitely there is more froth, but there is a very good portion of our rally is a function of fundamentals. I think that's a big message which I would like to pass it on. Again, if you look at the sub-segment, right, starting with cyclicals, banking came with a phenomenal numbers. Credit growth has been very steady. They don't have big credit cost. The only pressure point today is the NIM, which is getting corrected due to the repricing of deposits and a little bit of operating expense slightly elevated due to investment in IT. But otherwise, a very strong set of numbers. Why, again, very important to know banking performance is, if you look at any index, right, today banking is anywhere between 30 to 40% of that index is banking. So when banking does stable and steady, right, it gives you a lot of stability to the market, and that's what we end up seeing it. As I told, oil companies did a big number, close to 40,000 crores was incremental. That's primarily due to FY 23 numbers, which was last year number was subdued. These numbers are more reflective of the normalization, but I think that 40,000 crores is what getting captured in oil, like a BPCL, HPCL, all that type of a company. Automobile is a story of this entire season, right? Clearly, both the demand is coming back, margin is coming back. As I told, right, finally you're seeing the behemoth like Maruti Suzuki is investing into Capex, Toyota is investing into Capex. A lot of new products launched by all the two-wheeler companies. MHAV doing extremely well. Both Ashok Leyland and Tata Motors are firing in all cylinders. Tractor obviously is already in high base, is slightly subdued, right? So clearly auto has come back strongly both on volume. Mix of the products are getting changed. India bought two-wheelers and bought cars. Today, India is buying better two-wheeler, better cars, right? We are buying more of an SUV. We are moving more of a premium vehicle, right? Clearly, the volume growth doesn't reflect what the actual trend. The actual trend should be captured in the average buying price of each vehicle, right? Clearly reflecting we are buying better vehicle in this cycle than the previous cycle. And that's where the profit pool is also getting enhanced. Power also did very good. Again, in power, one stock like Adani Power skewed this entire data of 6,000 crores of more profit. Otherwise, they had a very stable growth. close to 20% type of a growth. But one stock really moved the needle, and that's where this 95. Mining did well. As I told, chemical is one space where we saw pressure both at the volume, margin, everything, and also getting reflected at PAT. So this one sector where decisively it's been down. Infrastructure is firing in all cylinders. Capital goods, another story which it's not only story, right? The sector is doing extremely well and a very underlying growth of 30%, clearly reflecting the mood. So broadly, cyclicals again did strongly well over this entire period. If you look at non-cyclical, again, it's the very similar story which we spoke, right? IT had a very subdued growth. Interestingly, FMCG, even though the sales growth was 8%, they had the profit growth of 17, primarily due to they gained back a lot of gross margin, and then they were able to retain little more operating margin. So they had the margin expansion going in their favor, which was not there with IT. Because if you look at in IT, the currency also did not depreciate in the last 1 year period substantially, right? We are at that 82 to 83 as a band. So this 3-4% is also missing to IT companies, right? So in that terms, FMCG did very well. Otherwise, broadly, it's been a good whole result season from a PAT growth. This is a very interesting point where how we think about in which sector where the sector itself is doing good, in which sector where sector aggregately is not doing good, but there are sub stocks are doing good. So there are 498 companies numbers have come in before that results, right? So there were two companies which did not either publish numbers or their numbers are fully out of the order. So we have moved out. So if you look at 45 companies out of healthcare, there is an interesting ratio which we're capturing called high growth and low growth ratio. I'll define what is high growth to low growth. Since I told India GDP is at 10%, right? So we divide the entire growth of the company, which is profit growth, about 10% to 20% and 20% and above, right? This is considered, this both the buckets considered as high growth, and anything below 10%, which could be 0 to 10% or less than 0, which is negative growth, is low growth. If you look at healthcare, which is 1.14 as a number, so for every 1.14 stock of high growth, there is one stock of a low growth. So typically a sector where it's a very neutral sector, but if you double click and see, there are a lot of stocks, close to 21 stock out of 45 did phenomenal PAT growth, clearly reflecting it's all about going to be bottom up investing in healthcare where you get the right stock, which has the right type of a product mix and right type of a balance sheet structure, right? Was able to capture the growth. Look at chemicals. Clearly, the trend is very visible. 0.63, it means for every company of growing, right? The degrowth is very significant, right? So clearly, the growth companies are 63% and the degrowth companies is 100%. And that's also reflecting, right? Less than 0, which is number of company reported negative profit growth is 21 out of 44. Clearly reflecting the underlying stress. Few of the companies will come back strongly, no doubt, but we need to understand the numbers are definitely not supporting couple of narration which we end up seeing in some stocks. Finance did extremely well. Again, it's a broad-based recovery. So wherever the sector growth is like 2 and above, right? Playing the sector will become very critical. So you be right, broadly right with the stocks, you end up making a lot of money because the sector tailwind will take care. Auto clearly right. For every one loser, there is 2.7 winners, right? So clearly the trend is so robust in auto, so robust in capital goods, construction, which is infra, right? Power. So if you look at sectors which is showing mega trend, which is all cyclical, and few names like FMCG is also shown some bit of right. As I told, rural economy is slowing down. In couple of names, there is a price correction, right? So there is a little bit of a pressure point in FMCG. Consumer durables is also slightly weak. Textile, another global place where there are few companies did very well, but most of the company did not. But for you, the aggregate is out of 498, there is 1.34 is the number, right? So for every one company which did not grow, there is 1.34 company which did extremely well. I think that's a big picture. Corporate India has more winners than the soft patch during this period. So clearly reflecting the underlying robust economy and reflecting in underlying corporate fundamentals. So moving on to the last slide on the numbers, this is the metric which we keep tracking consistently over a long period where how does the entire 498 number sits in a one metric. So I'll tell you how this number to be read. So if you look at on first on the rows, right, this is sales. So there are 108 company where the sales growth is negative. There are 148 company where the sales growth is between 0 to 10%, and 101 company where the sales growth is more than 10% to 20, and 141 company where the sales growth itself is more than 20%. It means clearly close to 30% or 28% of the universe growth is far robust than an India GDP, right, which is 10%. Or if you submit 141 and 100 and right, close to 240, which is 50% roughly growing more than India GDP. So clearly, we have a very good set of winners from a growth, and obviously few of them are slightly slower, softer. They both are primarily from rural India or from a global exposure. But very interestingly, if you look at profit growth, I'll take one number, more than 20%. We have 241 companies where the profit has grown more than 21%, 20%, right? So you have 141 companies did more than sales growth of 20%, but you have 241 companies did profit growth of more than 20%, more than 100 companies, right? Vis-a-vis, clearly reflecting that one summation of this result, we were to give it to the margin expansion. Obviously, margin expansion is not a very sustainable way to grow very long period of time, but I think clearly corporate India do have pricing power. They are able to pass it on and able to retain a decent amount of margin. So what we want to see over the next couple of quarters is how the sales growth number get a little more broad based. The number of company reporting less than zero growth should go down, because that's where the economy is getting a little more broad based. So that's a trend which we want to see. There is 65 companies out of the entire 500 or 498 had both negative sales growth and negative PAT growth, right? So sometimes the opportunity opens up in this segment where the current operating numbers are very weak. Market might ignore for some period of time till some evidence is coming in. So few of the great winners can come from companies with low operating environment currently, moving to high growth trajectory next 3-4 years. So that's where for us this is a very good table which we keep seeing after every results. What type of a company sitting in every bucket and where the opportunity lies for us to invest, given the 3 to 4 years perspective. So having spoken the last slide on corporate India, again, the TTM numbers for the top 50 companies been phenomenal. We have 34 out of 50 companies are reported the highest profit on a 12-month basis. That's what reflecting in this green color. Again, reflecting the underlying mood of corporate India is doing extremely well. So having spoken about how corporate India has done, India is doing and the corporate India, now let's get back to certain perspective of what's a commentary or the outlook. The first one is, there's a very interesting slide came out from L&T presentation, which clearly reflect what the mood which has been reflected in the con calls also, right? India resilience among global turbulence. I think no better way to capture the behemoth is putting out, and without it's very important to see, right? So if you look at the pain point, political risk is very high. Undoubtedly, we have to keep. Inflation risk is slightly getting moderated, but we have to be keeping the mind. The global trade is also not very smooth. But for them, interestingly, the Capex cycle in the Middle East is doing good. But in India, the commentary is very clean with what we have shared in the beginning, right? Capacity utilization is picking up, so which will put up capacity, which will support the banks in terms of credit growth. Balance sheets are extremely good. Public Capex is happening, which we are seeing in the entire government, and consumption trends are improving. So clearly, right, if you have to take one thing positive, right, I think a lot of corporates are calling out that India is in a really good wicket, and that's what our message to our investors. Something very similar from SBI, again, the behemoth from an Indian banking point, right? Clearly a company which has a largest credit exposure to India, right? So the credit growth has been pretty stable. Revenues for GST has been eating close to all-time high. There is a very interesting data which SBI puts out, which we don't end up getting this data from others, is high frequency indicators aggregately, which SBI follows internally, right? Which was slightly dipping till March, is slightly now getting accelerated post the monsoon, clearly reflecting the economy is growing a little better in the last lag end. And the whatever commentary to go by, I think during the festive season also economy revived. I think the economy is in a great shape from that point. Index behemoth. So one of the underlying underperformance of the large cap or the Nifty, right, is the large cap stock, which is an HDFC Bank, gone through the entire merger process for last 18 months. And if you look at recently, they just completed the entire merger and they put out this data fantastically. I thought it's very important for our investors to think about, right? So they have 9 crore customers aggregate at bank. And if you look at the subsidiaries, right? So a couple of subsidiaries is listed, a couple of subsidiaries part of the even the large index, which is Nifty. Like HDFC Life has only 60 lakh customers, HDFC Mutual Fund has only 80 lakh customers types, right? So huge growth possible, and that's what the bank is ready. Why it is very important? So you saw a period where a very large company like HDFC Bank went through this entire merger, got completed. And if you look at the weights, it is 14% weight in the large cap index, which is Nifty 50. And even in S&P 500, right, it is 8% weight. So clearly, right, when such a large company has gone through completion of merger and going to come back, that'll get reflected in the overall index movement. So I think economy is doing good. Whatever the internal things are now set, all set. Going to sectors where things are firing, as the numbers alluded, the narration and the commentary, right? Infrastructure growth is on a song. Again, no better evidence than L&T, right? If you look at order book, so one of the biggest significant factor for an infrastructure company is visibility of order. That's where they end up hiring people and finally it gets in, right? They have, right? I think for a pretty long period, infrastructure company never seen an order book growth like what we are seeing, clearly reflecting the underlying growth of infrastructure. And again, right, clearly one of the big slide out of L&T is right, 72% growth, highest ever, and growth is reflecting both in revenue and the order book. Clearly, a very, very healthy environment for a lot of infrastructure company. Obviously, few things are priced to the perfection, but definitely as a country, we are building good amount of infra in this period. Again, in line with what the commentary and the numbers, right? Consumption is extremely weak, and this is one another evidence, right? Where infra is firing, the next opportunity will come up consumption. And if you look at consumption, right, across a segment, it could be staples, discretionary, the volume growth is extremely subdued, right? From Britannia, Colgate, Dabur, you take any name, a typical volume growth of 2 to 3% is what happened in the last couple of quarters. And that is clearly reflecting in the stocks is also underperforming. So one important message is, right, there used to be a very strong narration of you buy high free cash flow business, which is typically all these business are very high free cash flow in nature. And you can end up paying 80, 90 multiple and then, right, you stay long for 20 years, you'll make money. I think this 20-year story is all fine, but eventually, right, we allocate capital given a 4 to 5 year perspective, right? Every 4-5 years, we have to keep evaluating. There will be always a periods where these companies also go through a cycle of a slow growth, and that's what clearly we are seeing. And those who clearly tracking the market also seeing that a lot of these great companies with a great balance sheet, great free cash flow structure is also underperforming complete market for last 2 years, reflecting if your starting valuations are excessive, right? When the business goes through a slowdown, it's going to hurt a lot of investors. So I think we have to be very careful. Even though we buy great companies, we have to buy it at a good price. Clearly what we as an ithought practice in every of our funds. So having spoken all these three to end, is there any opportunity, right? So we have seen a fantastic results, fantastic economy, good commentary, pockets of a slowdown, which could be the opportunity. There is one big opportunity opening up, according to us at least, which is in large cap, and I'll share some perspective. If you look at the flow data, very interesting data came from Kotak Institution, right? If you look at the flow data for last 2 to 3 years, and particularly last 1 year, large cap funds are not getting any flow. I mean, absolutely negative flow. If you look at month of May, June, July, August, September, October had some bit of a flow. Maybe no big redemption would have come in, but primarily money is not getting into large cap. Money sometimes I don't think I cannot say it's blindly, but I think there's a lot of euphoria chasing smaller names, and obviously, right, the past returns have been good. But if you take history, right, whenever the past returns have been extremely excessive, right, we have to come with either with a very long-term perspective of 5-10 year view, or we have to think about what are we paying up, because whenever there is excess return, there is a very good chance we are paying up for the growth. And when the growth disappoints a bit, right, the gestation period for the investment to turn right will become longer. I think that's a message. I think in large cap, where currently it is a value space, people are not paying attention. Supporting this, the biggest large cap investors are FIs, right? And they are also been not coming forth, right? Last couple of months, we are seeing FI flows are negative, clearly supporting. Flow is one space which is not supporting large cap. So whenever we are going to see flow coming back to this space, which will happen eventually, right, when FIs can come back, this window is clearly open to all the investors to allocate capital now to enjoy the benefits in the next 2 to 3 years perspective. Valuations are turning very, very attractive. I think if you look at large cap as a space, right? So there was a very beautiful article came out where mega caps are in bear market, large caps are in okay market, and couple of at least few pockets of micro caps and small caps are in a big bull market or an euphoric market, right? I think this data clearly supporting the direction. Large caps are very, very cheap. So if you look at historical average for the market, right, which is 20 times, and today we are trading between 17 to 18 times, clearly 10% discount to long-term average. Given the good balance sheet, given the good flow, I think next 2 3 years, I think this is a big window opening up for investors to allocate capital into large cap. Interestingly, large cap growth is going to be very, very stable. Broadly, in the next 2 years, right, the growth of the India market is going to be 11 to 12 to 13% growth, primarily driven by banks will have a steady growth in FY25 and 26. The growth will accelerate. Consumer staples growth will accelerate steadily after the rural recovery. IT will come back. So clearly, we are seeing growth will be broad-based. Growth is getting very, very stabilized from the next 2 to 3 years perspective. And interestingly, good growth coming, and expectation of the growth is also very, very stable. So if you look at FY24, right, we started with 917 as an EPS estimate, and more likely we are going to end at 959. So clearly, 4 5 years back, one interesting trend used to happen during this time period is as the results disappoint, the market keep adjusting the EPS downward. But now if you see, market is slightly adjusting the EPS upward. So FY24 EPS, so if it started at 917 rupee, now we are thinking about 959 is going to be, right. So clearly corporate India is doing better than what the market is initially thinking. Similarly, FY25 EPS is very, very stable between 1070. Now we have moved to 1078, clearly reflecting this is one space where growth is coming, growth expectation is stable, valuation is very attractive, and flow will only going to get better in the next 12 to 24 months. So how do we get this opportunity captured? I think we have a fantastic product called True Blue under our PMS, where it's absolutely high quality blue chip investing. And if you look at one of the space, right, in Nifty 50, so all the top 50 companies are universe. Nifty 50 also gives a very interesting opportunity. The topmost company, which is Reliance Industry, delivered 19,820 crores of profit. But the 48th Nifty company, right, which is Apollo Hospital, had delivered 250 crore. It means within Nifty itself, what we see, the difference in profit range is extremely wide, even though they all are mega caps or large cap. The really, really large ones are very, very large. So the opportunity from our point of view, right, there could be a very large company like Reliance or maybe an Infosys can have a slower growth, but there could be a very good segment within the Nifty top 50 itself, right? The growth could be very, very sharp. So the two companies which reported loss, one is UPL and Tata Steel. So that's why the 48th is the most profitable company with a 250 crores of the profit. The aggregate profit of Nifty 50 companies is 1.9 lakh crores. So I've shared BSE 500 have delivered 3.2 lakh crores of profit. Within that, this 50 company alone delivers close to 2 lakh crores of profit, clearly capturing a big profit pool. In our True Blue, right, clearly the 21 stocks which we are part of the portfolio captures 27% of the market profit. Clearly, if you are looking for a very high quality large cap universe, I think this portfolio is well designed to serve your needs. Again, right, if you look at the True Blue portfolio sales growth, very stable at 21%. So we saw aggregate market is 5%. If you remove the distortion, 8 to 9%. But our portfolio growth is close to 21, clearly reflecting our portfolio companies are far more stable than the market. Profit growth is also very healthy, 19%. Again, both cyclicals did very well and non-cyclicals also did extremely well. So this is one last data which I thought it's very interesting, right? How we run our large cap is, if you look at the entire market has 80% cyclical company, 20% non-cyclical company from an overall profit pool. This cyclical piece will give you sometime aggressive profit and sometimes they pull it back. Sorry. If you look at True Blue, close to two-thirds of the this one into 62% is into cyclicals. A very good healthy 40% into non-cyclicals gives you a lot more stability. So the investors who are looking at a very large cap portfolio with a stable profit growth, I think True Blue is well served for the investors. To conclude, Indian economy is in extremely good shape. I think we have shared enough data both from the fundamentals and the corporate commentary. Corporate India is doing extremely well, both from the results, both from the balance sheet and the cash flow. And finally, there are definitely pockets of areas where so that's where the opportunity lies in the next 2 to 3 years. With this, I think we will take questions. I'll be happy to any questions. Thanks for your time. This is our fund performance. Just for your reference, how we have done in our funds. One is Solitaire, which is a multi-cap fund, where in the last 1 year has been a pretty good, as I been a great phase for all of us. We delivered 33%, roughly 32.39, vis-a-vis market delivered 9.63. True Blue last 1 year again did extremely well, 12% vis-a-vis the market did 7. Vriddhi, which is our small and mid-cap fund, did phenomenally well, I would say, percent, where the markets delivered 9.6. Our multi-asset fund, which has delivered 23.7, again extremely well, given it's a multi-asset in nature, and where the index has delivered 7.53. This is just to share how well we are able to translate our entire data-dependent research team functioning to see how well we can capture this growth to serve our investor for the long term, which is 3 to. Thanks once again for the time you have given, patient listening. We'll be very happy to take the questions forward. Thank you. Tarun, we can open the floor for questions. I'm extremely sorry, I did not see, I think voice was breaking. Hope that my predominant session voice was good. Let me take True Blue, Solitaire. Which scheme is suitable for whom? Please explain. Starting with True Blue, True Blue is a very high quality large cap. So typically our entire universe is Nifty 50 stocks, where we end up seeing companies which has a good balance sheet structure, good governance, good growth, and reasonable valuation. So those who are looking at a high quality, a blue chip large cap portfolio, right? Pure large cap portfolio, I think True Blue serves extremely well. If you look at Solitaire, which is our flagship scheme, we are close to 800 crores of AUM, which is a multi-cap portfolio with a good mix of large, mid, and small. So if you are okay to take slightly higher risk in terms of having both mid and small cap also part of the portfolio, and want slightly little more higher return expectation, I think then Solitaire fits for you. In which way PMS is superior to MF portfolio? I think it is. I think both are very, very different and complement each other. MF definitely serves a very big purpose for investor who has less than 50 lakh capital. To put in perspective, for PMS by regulation, 50 lakhs is the minimum capital required for every scheme. So that's point number one. Otherwise, I think MF runs a very broad strategy, a well diversified strategy, serves a lot of people. But one of the things which we see a very different thing is if you look at for example, large cap, right? A typical large cap owns 50 to 60 stocks in a large cap fund, right? So if you look at large cap, there are 100 stocks and you own 50 to 60, it means typically every second stock in the market you end up owning in a large cap fund. But if you look at True Blue, right, we own today close to 22 stocks within the top 50 or top 100, right? Clearly reflecting it's going to be far more concentric, far more focused, where we have high conviction we end up investing in. So that's where I think this gets differentiated. I think otherwise both serves its own purpose. While flows are favorable for small and mid cap at their high valuation zone, definitely flow results in high valuation, right? Clearly good question to ask. So what we see is definitely there are pockets where the numbers are extremely in line with even large cap, but small caps are today trading at premium to large cap. So typically, right, if you look at large cap, these companies where small cap did extremely well in business, over a period they have become the large cap. So they have better track record than a small cap. So generally large cap tend to trade premium to small cap or the mid cap. But what we are seeing today, since the flow is extremely very aggressive, we are getting a huge flow through SIP, right? So close to 16,000 for SIP is coming, and predominant SIP is coming in small and mid cap. flow is too strong and the monies keep going into the particular pocket. And we are seeing definitely in particular pockets very, very high exuberance. So in pockets, definitely the valuations are not very attractive. PMS is transparent like MF, of course, right? So PMS is also regulated by a regulator, and the entire portfolio you will be owning it, right? So the entire investment will be done in your demat, right? Even though it's a discretionary. Clearly, it's very, very transparent. The only big constraint comes in size, right? So it's a 50 lakh is a minimum size needed for PMS. Unlike in mutual fund, typically the size is 5,000. Thanks, Ashwin, for comments. Good data. Slides not display. Okay, was getting. So next time, missed Vriddhi return. I think so if you look at Vriddhi performance, I'll just run for the benefit. Last 1 year, Vriddhi fund has delivered 51.81% vis-a-vis the index delivered, which is BSE 500 TRI 9.63. 2 years is again a very credible 26.93% CAGR. This is all post expenses. Hope that answers your question, Mr. Deepak. Thanks, Hariharan sir. Thanks. Do you think infra and chemical sector will do better in the next financial year? What's your outlook? Is it time to invest in both the sector? I think clearly infra, after a very long time, India is investing into infra. I think no better place if you're in Chennai or a Bombay or any city, right? We are constructing metros, we are constructing roads. So every infra piece we have to talk, right? It's happening. But it doesn't mean we buy the segment irrespective of price growth. So it's all about investing is all about where demand environment is good and going to be good for over a long period. But you have to buy good company which can also generate economic value, right? So if return on equity of a good infra company is more than 20%, right, they add value. But if you find an infra company with let's say a return on equity of sub 10%, where the cost of money itself is 12, right? Even the growth is there, it doesn't add up to value. So that's where I think instead of taking a broad call of infra and chemical, definitely the opportunity is opening up in infra, but you have to be very selective because last 2 years infra is doing extremely well. So you have to be very careful today. Chemicals, I think the data is not supporting currently. Huge capex is going through in a lot of chemicals, right? You go to a balance sheet and cash flow, we are clearly seeing they're using the balance sheet to build big capacity and the demand is down. So we have to wait out and see. Currently, we don't have any exposure. We are definitely monitoring the space, but as and when we think the capex is commissioned, the P&L is reflecting the pain of the capex, right? Because when the capex comes in, what you have to also understand, the depreciation goes up. There is going to be a little more stress on the P&L in terms of people expense because they will put people into the plant, but the capacity utilization will take time, right? So we have to see, and if everybody is putting capex, how the entire industry is going to use the capacity because it's not one player. If you look at capex, multiple players are doing capex and chemicals. So I think this is a space where we have to go one by one and take a very singular approach rather than taking a very broad-based approach. Hope that answered your question, Mr. Manigandan, sir. Thanks, Kumar, for this. What outlook for gold ETF? Broadly, as a house, we have been pretty positive in gold for last couple of years. Primarily, what we are seeing in the global environment, right? Both from mismanagement of monetary policy resulting in a huge inflation. Now, this should result in definitely currency having their own toll, right? At some point in time. So we clearly see there is a merit of having gold. How much gold is a question of where are you in the cycle, what you want out of the gold. We are very, very positive in the medium term. Thanks, sir, for your comments. Hope it helped you to think about better. Thanks, Karthik, again. Hope this data helps you to be positive and right. Please show the performance numbers of the funds did not appear. I'll show it, I think. Hope you're able to see the this one screen. So I'll repeat just for those who are not able to see it. Solitaire last 1 year, 32.39% vis-a-vis markets have delivered 9.63. For us, very interestingly, last 2 years, right, where the markets have delivered only 6.74%, which is BSE 500 TRI, the fund delivered 22.45, clearly reflecting the underlying philosophy getting reflected into stock selection, and active investing is extremely kicking, right? So similar to True Blue, last 2 years where the index, which is Nifty TRI, delivered 5.15, the fund has delivered 8.92. Vriddhi, as I've already alluded, did extremely well. And Spear is it is not completed 2 years, so the 1 year return is 23.72 vis-a-vis NSE Multi-Asset Index 1 delivered 7.53. All the four funds have outperformed in the 1 to 2 year period over the benchmark, and other funds have delivered till the inception also. Hope, good presentation. Okay, what about short-term capital gains in PMS? Frequently will change fund. So one of the thing, very interesting question. As a house, we are clearly a medium-term investor. Our view is we take typically 3 to 4 years as a perspective. If you have gone through our videos in the past also, right? Clearly we take call given the medium-term outlook. So we don't do trade in, trade out. To put the data in perspective, in solitaire, the churn ratio is so low that our entire portfolio turnover ratio is close to 0.2 to 0.24, right? Clearly reflecting we end up holding for 4 to 5 year period. So clearly, our way to invest is we invest in a good company, allow the compounding to take place. So you're not going to have a lot more transaction. But obviously, right, at some point in time, you end up selling, and that will result in either in a short term or a long term. Even in a mutual fund, right? Finally, you sell at some point in time and you make gains, you have to pay the tax. So tax is inevitable. The question is the incident tax will change. As a house, I think ithought is well served because our holding periods are typically longer, and we are reflected both in solitaire, True Blue, Vriddhi, and even in Spear. Hope that answered your question, Mr. Ravi. What about the global instability affecting the prospect? I think we have to live with global instability. This is a fact of, it's a truth. No way about avoiding it. The way we need to think is, as long as you find a good company which has a great product, able to sell to more customer, able to sell more, deliver more profit, more free cash flow, more dividend, all-time high, I think clearly the market will price it, right? Irrespective of what's happening in the world. There will be always some concern going to happen in the world, right? If somebody would have told solitaire is close to a 4.5 year old product, somebody would have told in 2019 when we launched the product that you're going to get COVID, then you're going to get war, you're going to get highest inflation, then you're going to get Fed hike. Would you like to launch a fund? Probably we would have thought, oh my God, so many things are going to happen. But actually, if you look at the way we have compounded capital, right, clearly reflects a very healthy compounding for a 4 year period, reflecting the underlying opportunity is very, very good. Definitely, the news flow from a global construct is going to be negative. That we should expect, and still stay invested in good company where the customer loves the company, right? So finally, all we are looking at is show me a company where the products are loved by the clients and they're willing to pay up. I think we are there to make money, right? So that's investing for us. Is it True Blue? Is a new product? What is the terms? I think True Blue is not a new product. It's close to a 2.5 years old. It's a very, what is a curated first in a country where we have designed the entire product out of Nifty 50 universe, high quality, large cap. So it's already a 2.5 years old product. We also enabled in True Blue a complete variable fee product. So those who are also wants a low cost, right? So True Blue could be a good option where up to 6% there is no fee. After 6%, it's a 20% profit sharing. Great presentation, compelling argument. Thanks, sir. Hope you liked it. Thanks, Annamalai. Wonderful, Balaji. Do you think still the American recession story is over? I think America has done, actually, US has done much better than what everyone thought in the beginning, right? I think if you look at the year beginning commentary, the recession was about to come in 2023. Definitely did not, right? You have to look at what is our edge. As a house, we are very, very clear. Happening in US, it's good to know what's happening in Europe. It's good to know what's happening in Japan and so on and so forth, and China, right? But finally, we have to see, right, where does costed their assets, where the customers are residing. These corporates are generating more sales, more profit, more free cash flow, and they're doing more dividend, more buybacks. I think our focus is reasonably on the last piece more, even though we do track. So I think recession might come, might not come. We are not the macro specialist. I think our edge lies in finding good company where the growth is going to pick up in next 2 to 3 years, where the free cash flow profile is going to improve, where the return on equity is going to improve. And finally, when the market sees this data, right, they reevaluate both the valuation multiple and the earnings, right? So clearly we want to capture that. Our entire energy is going into that, and that's where our endeavor is also. RBI recent comment on easy retail credit is a concern for private banks. Does TrueBlue include both private, public sector? So TrueBlue is predominantly as invested into private. I think retail credit slowdown is good. I think India is going to have a healthy growth, right? So banks will capture the big growth. What I told, right? India's GDP moving from 87 lakh crores to 300 lakh crores to 800 lakh crore, right? How do you capture this 300 lakh crore to 800 lakh crores, right? Think about one sector touches every single sector is banking. So I think banking is an extremely good position. If you look at the capital, tier one capital for a lot of private banks which we own is 6-7% more than the regulatory requirement. So clearly they are well capitalized. There is no NPA issue. The growth engines are well set. I think this is a very good policy in the medium term. Why? Any excess can hurt us in the medium term. So I think RBI thing is not to slow down the entire economy, but RBI doesn't want to have growth disproportionate to what the underlying economy can observe. I think this is a good development. We see a very positive development for the sustainable value creation for all of us in the next 3 to 5 years. And we own only private banks in predominantly in TrueBlue, no PSUs. Can you elaborate Q2 of 21 with the previous year with slide again as to understand, please? So broadly, if you look at sales growth is 5%. If you again remove the couple of pieces, the sales growth is 8 to 9%. Profit growth is 40%. Again, you remove the distortion, profit growth is 20%. So broadly, growth of 8%. If you remove the distortion, growth of 20% at aggregate, very stable growth, and close to 50% of the companies are growing much better than the India growth, which is 10%. If you want more, you can just message us. I think infra chemical, I think I've answered. What will be outflow? It's time to invest in both of them. Very informative. Give me a view on logistics. I think logistics is one sector which is going to be very interesting in next decade, because if you look at India, right, we are going to grow not only India level, we are going to do a lot of exports, right? We are doing the manufacturing at PMI level, where we're going to do a lot of manufacture for India and exports. For exports, one of the important critical ingredient is we need a very efficient logistics, and that's where I think your dedicated freight corridor is going to come in. Your lot of expressways are going to come in, right? So this is going to be a very interesting space. Obviously, there are a lot of stocks that are very. It's a very universe is very tight. We do have some exposure to logistics. We are very positive. At some point in time, definitely this weight will go up. An interesting sector to observe. 100%. When do you expect pick up? I think it's $1 million question, but as we see inflation finally in India is stabilizing, right? So we have not gone through what the West has gone through, right? For us, a severe inflation was in the year, if you recollect, in 2012-13, where it used to be double digit for a very long period. I think India has not seen that type of inflation. I think rural economy should come back at any point in time, because we are seeing tapering down, and it's getting commented by all of FMCG companies, right? They are passing on the prices. Really wish and hope is in next 12 to 18 months, this should come back. I think definitely government is also cognizant of this. So if I pick the market in last 3 years, how has been performance, the new entrant, public markets, very interesting, right? So and where companies getting subscribed 50 times, 200 times, and nobody wants to buy it today. Is I think there are definitely few good companies are coming, but we need to give time both to understand them better, which is the management and the business model. So as a house, we typically don't end up participating. One of the biggest benefit of last 4 years where we have not participated in any IPO, and that resulted in a lot of gains and loss. So clearly reflecting our way of being a little more conservative. We will take every idea as it comes. We will not rush ourselves, but definitely few of the names which is getting listed are very interesting, both from business model point of view, and it gives you a very unique exposure for the next 300 trillion economy, right? A very large economy capturing. But we are not participated in any of the IPO in the last couple of years. Please flash the PMS product performance slide where TrueBlue with a solitaire multi-asset as it did not show up. I've spoken about this number, sir. I'll show it in the end if you want. Good presentation. Do you Do our India mega caps like Reliance, TC, Infi, HDFC banks are in a maturity stage? What are we expecting in growth? Definitely not in a maturity state. As I shared one of the data, right? 34 of the Nifty 50 company have reported the highest profit growth just now, right? So a lot of large caps are doing extremely well. Obviously, right, if you look at Infosys and TCS, they are very large company. They will do far better when US and Europe do well. They'll grow at 12 13%. When the world doesn't do well, they will do 8 to 9. Broadly, I think you should expect a 10 to 12% growth. That's a long-term growth, and that's a very good growth for a large cap. You also have to understand for IT company, there is no capital requirement. So every money they generate as a PAT is typically free cash dividend. Either they pay out to shareholders or they buy back. So these are very high quality business, growing anywhere between 8 to 12% in the long range, and 10 is the median, right? Reliance definitely is going through a big capex cycle. The ARPUs have been very constant, right? So they have not gone through a tariff hike, so they will come back. I think if you look at HDFC Bank, right, I think this company is nowhere in maturity state, right? The company is continued to grow at 15 to 18%. If you think maturity, right, maturity is about having a subdued growth. I think 18% means you're going to compound your business in 4 to 5 year doubling. I think very, very healthy growth, right? India itself is growing only 10%. So I think the data is not collaborating. Mega caps also is growing. Obviously, few micro caps will grow at 100%, and we should not get swayed because one, they will not sustain, and it will be far and few. You cannot capture the entire portfolio only with this type of names. I think we should look for companies which is growing around 10%, right? I think that's a very sweet spot, and a lot of companies are delivering. Among mega large cap, which sector should do interesting to watch out 3 to 5 years? What's the house view? I think we are very, very positive on banking, given what India can produce for next, not for 1 year, 2 year. I think next 6, 7 years, right? We have cleaned up the both balance sheet of banks and the corporate. I think this growth going to be very long enough, hopefully, and banking can capture that one. Healthcare is doing extremely well. Healthcare peaked out a couple of years back, right? 2016 cycle, they peaked out. Now, finally, a lot of healthcare stocks are coming back. They are underrepresented at the index level. So one of the things which we are doing, the True Blue is, right, getting a little bit overweight in companies which are doing extremely well. Finally, we are seeing a lot of two-wheeler names coming back and hitting all-time high. One of the portfolio name where we are extremely positive, we hit all-time high day before yesterday. So clearly reflecting company with the less weights in index, but slowly hitting all-time high. And that's where the opportunity is going to be, right? Auto is doing very well. As I told, right, couple of companies are putting capex after 8, 10 years. Why would some big companies put capex after 10 years? Clearly seeing the visibility in the medium term. IT will do a normal piece of 8 to 10%. FMCG also will do, right? So these are two sectors. Actually, all you have to do is you have to buy at right valuation. The growth rates are roughly close to 10% over a very long period. Some companies tend to grow slightly better. Some companies tend to grow slightly off. But I think 9 to 10% growth you can expect for a very long period. That's what the historical trend for this company. The key to make money in this is when they're cheap, you have to buy a lot more. And then maybe the excess valuation and the story takes over. You go up selling it. Thanks, Ravi. Your view on risk to corporate earnings policy control market relating to election. I think election is definitely will have a lot more noise than the fundamental. We have seen elections, we have seen earthquake, we have seen COVID, right? We have seen COVID. I think these things will tend to come up and go. Hopefully, all policymakers are very, very clear. This is our one of the last opportunity as an economy to capture and become, right? Today, the world wants India to do well as much we want India to do well, right? So I think hope our policy makers are very, very clear about irrespective of which government were to come in. We don't think there's going to be a dramatic change in the way the policies are built. And I think the corporate should well behave today, right? They're behaving very well, both from balance sheet and cash flow. So I think we'll wait for it. Definitely, it's going to be a lot of noise, but these things going to come up, right? Every time you're going to have something or other. So you take a 4 year view, you should invest, right? Or if the government were to come and thumbing, right, the market goes up, then you'll be thinking you should have invested in the beginning. So it is very difficult to stay out of the market. What you should ask is it corporate India is doing good? Are they growing? And is the growth is going to be sustainable? I think if these questions are good, and if you find pockets where the valuations are attractive, today we strongly believe large caps are very, very attractive. I think that's a window is opened up. Use that window. Which sector and market cap are potential of, I've told, sir, I think one coming years, I think few of the sectors will do very well, like infra and related all. And that's where, right, I've shared a broad perspective. so many opportunity now foray into battery manufacturing. What is the future of battery company? I think the technology itself is evolving, right? So clearly, we are not into VC investing. Don't want to take a call where even the company doesn't even know how they're going to manufacture, or how whom they're going to sell, when they're going to sell, how much money they're going to make, whom they're going to compete. So I think these are evolving things. We will take as it comes. Once the dust settles, you know clearly who is a winner, and then you also have to buy it at right price. But definitely, it's a technology of the future. We have to monitor. So a couple of names which supports this technology is what we are monitoring, right? Company which will be into material science, which will benefit largely out of these things, we will monitor. But I think we have to take case by case. I think as a house, one thing we have to be very clear, we have to go by numbers predominantly, because most of the narrations will be always good, but narration doesn't result in numbers. We have seen in infra, we have seen in many sectors in the past, narration takes over numbers and then eventually the stock falls, right? How do you see the position of HDFC Bank in the future, say 10 years, given the recent merger? I think they are phenomenally positioned well. They're all set, and we wish them the good luck. Let's see. We are extremely positive on this company. Bajaj Finance has been one of the largest wealth creator. Do you see winner of the scale coming up? Definitely, there will be a different winners. They have done very well. But finally, if you have to see, right, today, Bajaj Finance is not a small company. The balance sheet size is more than 3 lakh crores. They are only into retail predominantly, right? So they have become very size. When they started of this journey, they were too small. Today, every bank has retail focus. Few of the NBFCs are again retail focus, and the leader is definitely Bajaj Finance. And even RBI governor now wants to slightly get defocused. So clearly, this space has to be watched out. We are not having a very high exposure to this segment currently, at least. Outlook for gold price I've shared broadly. 50 lakhs is the minimum requirement in PMS. Yes, sir, this is by regulation for all the 4 funds. A bit of close to 1 crore by value. If you want to split in this 2 PMS account, put 50 lakhs all at a rest, in which PMS is a good time to invest, full growth. I think if you have 4 to 5 year perspective with a reasonable return expectation, right? So as a house, every product here to serve very different need. True Blue, right? So market expectation of 12%, True Blue to 200 to 300 basis over the market over a long period of time. Then comes Solitaire, then comes between True Blue to Solitaire, you have Spear, and then you have Vriddhi after Solitaire, right? So these are 4 products based on your time frame and the risk appetite. All the 4 products, whichever 2 you would like to choose, but clearly your time frame should be close to 4 years, because one, as you rightly alluded in the beginning, right, we are going to go into an election season, very strong election season for next 6-7 months. Then we also want at least a 3-year window period where 12 corporate results will come out. Clearly the results will reflect in stock price, right? So this is the period where clearly we see there is opportunity and there is less competition from a overall market structure point of view. But definitely good opportunity to invest. Today, if you look at our day one deployment in True Blue is close to 70 to 80%. So we are finding a lot more opportunity in large cap. The day one deployment in Solitaire is close to 40%. And that 40% also predominantly into large cap. So today, what we are doing is, as the money comes in, we are investing predominantly to large caps where we are positive. We are going and investing now. We are waiting for some more volatility to come in, hopefully, and then we can deploy into our likable ideas in mid and small cap. Thanks, sir. We are learning a lot. Please continue this. Definitely, sir. One of the endeavor is a lot more spoken about India, a lot more spoken about global. We will continue this corporate India trajectory every 90 days, right? So we think as a shareholders, as a prospective investor, as an investor of India, right? You should know how our corporate India is doing good. And I think we will be doing this every quarter ending, 2 weeks out after the results, right? So this is exactly 10 days later, the results got completed 15th November. We took 10 days to prepare all, and hopefully we are able to share good perspective to you, which will help you, one, to stay invested in India and to come with a better outlook and bring more capital to Indian markets and to us. Fixed income market is becoming popular in current period. Reasons to consider extremely good. I think that's where our Spear is well served. Yield in fixed income has gone up due to thanks to repo rate hikes we have seen. I think those who want a very, very multi-driven portfolio with good fixed income, good gold, good equity exposure, good global, I think our Spear is extremely well served. We have a long track record of this product in RAF format. Finally, we converted the entire product into a PMS. It's a 300 crore plus, a very robust team handling this, both from research, analysis, and so on and so forth. I think that will be well served for you, sir. If you think clearly reflected, PMS, we want to run this. We want to have PMS for thing, right? Bull run, bear run, neutral market. Definitely, I thought as a house, we are very, very clear. We will take lower risk. So if you look at last 2 years where there is no bull run in the large caps or the bigger, our solitaire has delivered very the upward of 20% return, right? Really reflecting it's not only a bull run product, definitely not designed. If you are clearly having a 4 to 5 year, that's the nature of the investors we are serving. And irrespective of what the market outcome, we should find some decent ideas. So it will be all weather product and not only a bull run product. What's your view on hospitality sector? Right time to start? I think hospitality right time was COVID lockdown. I think from there, I think the legs are long. So we have to take case specific at right price. But definitely, what was the pain point for a couple of stocks like an ITC has become the gain right in last 3 years. So we take away any sector out. I think that's a reflection after COVID. People are traveling a lot. We're very positive, but right, because valuations have caught up. Excellent. Thanks. To invest all funds in people considering the potential. It's an individual call whether we should fully invest into market or we should invest 90%. But request all of us is come 4 year to 5 outlook, come with a return expectation of around 14-15% for a long period of time. I think we're well served. As a house, we are fully geared to serve people coming with this two time frame and return expectation. And all the 4 products are well designed, sir. I think this 100% is a call which you have to take. If you are comfortable with 100, you should. Otherwise, I would suggest you can have 5-10% of cash because at the end of the day, your comfort is far more important than making all the money, right? We have to sleep well. That's one of the primary way we think about building portfolio is how good our portfolio should reflect the way the client should feel comfortable of holding the portfolio even in the tough market. Last 2 years been an extremely good market. I think when we see tough market, right, that's where the clear quality of portfolio will get reflected. Thanks. How do you see fintech as a growth space? Well, creator for next fintechs, we are very well important. So I was just going through all the numbers of Paytm, PB, fintech, right? The way fintechs are going to make money is simple. They're going to use their payment gateway to make some money, but they're going to do a lot of distribution of loan products, a lot of distribution of insurance, mutual funds, so on and so forth. Very early days, but definitely you have to keep the eye right. So I was just thinking about Paytm does close to 3 lakh odd crores of GMB, right? So 2 to 3% of India GDP does through Paytm, right? Clearly reflecting they are very, very important. Close to 9 crore customer users the Paytm. So there are a lot of names which are very relevant. We are trading it. They are just becoming EBITDA positive, so they are not built a track record. We generally want to the track record to keep our investment profile risk lower. But we are definitely studying, watching at right price and right opportunity in time. We will have some exposure, but currently we have zero exposure. Thanks, Ramachandran sir, for your kind words. Performance in XIRR, yes. All performance more than 1 year is XIRR. Excellent. How do you see forthcoming recession effect? How do you see? I think our portfolios are growing better. If you look at solitaire or a true blue, right? Aggregately, the portfolios are growing at 15 to 20%, right? All we need is a bunch of 20 to 30 company growing at 15 to 20%. I think we are able to find. I think we are well served. So we are not going to switch off, right? So you have to live, right? You have to live with these things coming up. And India is not in recession. I think you have to take a bigger call that India is going to grow on leaps and bounds, and that's some positivity. How many companies in Solitaire delivered PAT of about 10% on sales growth? I think Solitaire today has 37 stock. 4 stocks had a negative sales growth. 6 stocks had a less than 10. So roughly 25 to 27 stocks have grown more than what the number threshold, right? So very healthy growth. That's what reflecting even in the price action. Sorry for putting this question in both the chat and Q&A. Sorry, I'm a newbie finance, hence a lot of terminology went overhead. Could you suggest some material for me to learn about? Definitely, Nikhil, you touch base with our team. We will help you. We'll be very happy to support everyone. I'm extremely sorry if certain terms have been not well explained. I'll take care in my subsequent presentation. We'll be very happy to assist you. Okay. Nitin, Lakshman, do you use technicals? How do you blend technicals? I think we don't use technicals per se, but having said that, we also look at the market structure to see what the market is more reflecting. So I think it's more to do with having invested to have a glance of it. Otherwise, primarily our investment thesis is a function of the product, business, sales growth, resulting into profit growth, cash flow growth, and the valuations, right? So it's predominantly into fundamentals is our primary investing tool. Your audio is off, sir. Sorry. I think what is the same benchmark used for? So I think this is something to do with what regulators have asked, right? So they have given defined benchmark for a large cap, mid cap, small cap. So within that, whatever is suitable is being taken. And even if you want a Vriddhi performance vis-a-vis a small cap index, we've done extremely well. We'll be happy to share it post this session to Mr. Deepak. It is way above. We are definitely in quartile 1 across the various funds captured both in mutual fund and PMS. Can insurance sector do better than banking in the next 3? I think both serves very different purpose, but we are very, very positive on insurance, particularly, right? If you think about auto, we are buying more premium vehicle, we are buying more EV. Both are very expensive from product, right? So if you are buying an ICE vehicle of a 7 lakh, if you buy a hybrid or a high premium or an EV, you'll be buying a 14 lakh. So instead of paying premium for a 7 lakh, you have to pay a premium for 14 lakh, right? So clearly, general insurance are very positively designed. They will capture the export growth of manufacturing growth. Life insurance has come back after a big shock of COVID. They had a huge expense on COVID, right? And mortality rates went up. Their reinsurance rates went up, and so on and so forth. So clearly, this industry is a very stable, high growth industry. We are very, very positive. But I think they serve a very different purpose than banking, right? So I think we're constructive on both. What is the long-term vision of ithoughtPMS for the customer? I think our whole objective is, can we run a very conservative product from a risk point and deliver superior outcomes in the medium term, right? So if you take generally PMS is considered as high risk, I think the data is also proving, right? Typically tend to take high betas. I think from ithought point, our lookout is, can we take lower risk than the market to substantiate the beta of solitaire or a true blue is anywhere close to 0.75, clearly reflecting 25% lower risk than the market and still deliver sustainably more performance than the market, right? I think that's our solution. And clients who have this 4 to 5 year time frame and thinking about wants to take low risk and still deliver consistent above average return, I think we are trying to serve that type of an investor, and I think we're very happy to serve. We're close to today 1,000 investors in all the funds. I think hope our investors are very happy, and we would like to continue to serve. We have built a fantastic team in the last 4 years. We are close to a 14-member team, both research, investment strategy, and the fund team, and obviously headed by Mr. Shyam, who is our founder and the CIO. How is the taxation for Spear as a multi-asset? I think obviously, right, it's at the product level. So if you have an equity will have equity taxation. If you have debt, you will have debt taxation. Obviously, right, tax on a multi-asset will be slightly different to pure equity product. What is the components of Spear equity? Does it follow solid true? So I think the philosophy is simple for us. Equity component is we will look for a high quality business which is generating a lot of free cash flow. Growth is coming up. ROEs are improving at a reasonable valuation. So from an equity stock point, the same team works, right? So we have a 5-member research team where I hire the research also, right? The same team supports the Spear in terms of building a good amount of direct equity portion. They have a separate entire team who does a lot of work on the ETF piece, which we have a good exposure. We have a global exposure. We have a good commodity exposure, which the entire investment strategy team functions. So I think the team uses both the blend of the equity research and the specific team operates out of mutual fund research. Put together is what Spear has been handled. And we have done the entire Spear for last more than 10 years because in RIA we used to manage the same multi-asset, and now this has become Spear with a 1.5 year of track record and phenomenal track record. How will AI impact Indian IT company? I think it's a very interesting initial days, but I would say I was into conference sometime back in the similar space, and a very interesting topic came up where AI will have a very differentiated impact for two types of company. Company with a good productive people will use this technology to raise the productivity. So it's going to positively impact companies. A company where the resource is really inferior, right, is going to get hurt because AI might replace them. So I think this is a cycle where the quality of individuals at the company level will determine companies benefiting out of AI, companies moving out of AI. I think IT is going to be a mixed bag. Company which is able to use AI better will benefit, and those who are not able to use AI going to lag behind, definitely. It's something, a trend which we should watch out. Whether Trueblue will invest only in Nifty? Yes, Trueblue is the first Indian product, very happy to share, where the entire universe is Nifty 50. What we have done is we have taken Nifty 50, trying to find areas where we don't want to invest first, right? In terms of it could be a governance or they have a lot of debt or they're not profitable, right? So if we would remove, you end up getting 40 companies where they are extremely profitable, they're well served, ROEs are extremely good. Out of this big quality universe, we end up want to invest close to 20 stocks where the growth is picking up, the free cash flow is picking up, and the valuations are attractive. So it's going to be only 50 stocks. And we have shown in the last 2 years, right? Clearly, we are able to perform far better with a lower risk, right? So the beta is 0.75, the churn is close to 0.1. Hardly there is no selling, because as long as you buy good company, all you're supposed to do is allow the compounding to take place. Do you see value migration as a theme, creating big winners like Titan did? I think value migration is part and parcel of every company. Instead of saying a theme for one particular industry, right? Every company, Indians are buying better products. So we are going to pay up for more. It's going to create a lot of value for a lot of companies. Would pharma continue to grow in coming days? Is the right time? I think pharma is coming back strongly. But again, right, you have to take stock specific. So we will not going to give a call that is the right time to start an SIP in a sector funds. But we are reasonably constructive in the sector currently. Valuable presentation. Thanks, sir, for the comment. Any plans to introduce category 3F? Currently, no. We are building our capability to broad base. Today, we have built an internal tech stack called ithought bot, which does the entire con call analysis using a cloud. So we are building a capability to see how well we'll be enhancing our offering. But I think currently nothing in the cards. So when we come back, we will come back and take your support, sir. Thanks, Jawahar. Very insightful presentation, very nicely articulated. Thank you, sir. In solitaire, what percentage allocation between large, small, and mid? Today, if you look at stock, 5%, close to 35% into large, mid cap is close to 15, and small cap 50. But again, if you look at our small cap, predominant small caps are debt free, and close to 65% of the small cap are MNC, right? So these are very large company at global. Their subsidiary is listed in India, and we have a high exposure. 11 company we have, which is MNC backed small caps, right? So that's where our small cap exposure is high optically, and they have done really well in the last 2 to 3 years. That's point number one. Point number two, on the flow for the new portfolio today, as I told, we are investing 40 to 42% on day one, predominantly large cap, close to 30%, and the balance into few small caps and mid caps. Since valuations have run up, we are going a little slow on small caps today. Hope that answered your question, Ravi sir. Can you kindly use Google Meet for future webinar? Today experience a lot of audio interruption. Sure, sir, we'll take this feedback and give it to the team. Other than quarterly fees, any other hidden charges? No, I think otherwise your normal operational fee, like a transaction fee and all that stuff, which is there anyway, close to 15 basis point. That's there for all PMS. Otherwise, only management fee, no other fee. If you want further details, my team will be there, happy to serve you on this. What are the ways to reach to the future who has 10 lakhs? So fun, good question, sir. So we have definitely a lot more wider ambit. We have something called M2W where we are supporting as a team in terms of there's a separate team to support where people who have less than 50 lakhs, right, to build the corpus to 50 lakhs, and then you can take it forward. You can touch base with the numbers which I've shared, and our team will be happy to serve you. IT valuation right now not justified in low growth. I think growth is not the only factor. You have to look at how much free cash flow this industry generate. Obviously, we are not saying today valuations are very attractive. The stocks have rallied. Few stocks have hit already a 52-week high. But these companies tend to grow only 10%. But you have to recollect, IT company generates all the profit as free cash flow. Unlike many industry where the free cash flow conversion of profit will be 10 to 50%. In IT, it is 90 to 100%. So it's a very high quality business model will command little more premium because of the generate ability to generate free cash flow. And if you do a DCF with close to a 10% growth of easily, right, 24 times multiple will up. That's what these guys are trading broadly. Hope that answer your question. But we are not really very enthused. We have good exposure at a low price. Today we are okay. Any overlapping stock between and True Blue, two overlapping stock of that. Intel also wants to invest into mega caps, and we do, but the overlap is very minimalistic to 4 to 5 company. Our whole idea is we want to keep the overlap less. If you see Solitaire, the active share of Solitaire is close to 80%. So we don't do benchmark hugging. We don't even see benchmark what's the weight from investing point. Our clear belief is you find 25 good company, give them the time frame and allow the compounding. And I think that's where the numbers are also getting reflected. Engineering R&D service like Elixir, Tata, Capex seems to good future. I think definitely very well. The numbers are very robust, but you also have to look at the price, right? So couple of names we do have exposure R&D, but we end up bought at 14-15 multiple, and today the stocks are trading at 20-25. Few R&D company we exited today trading at 80-90 multiple. So I think these are good companies, no doubt. The numbers are far robust than IT service, but finally, what price you pay is more important, right? Value you will get when you don't pay for the growth and then growth comes back. For senior citizen, which product is suitable from ithoughtPMS? I think instead of bucketing you, sir, from the age point, if you have risk appetite, how well and what time frame and expectation, all the four. But ideally, if I don't have anything and I still have to have a guess, True Blue and Spear are the products which are very low on risk profile. But obviously, right, it comes with a slightly lower return expectation than the other two products. Should suit you, but I think it should be a very individual call. We'll be very happy to have a conversation one-to-one. I have a good idea about what you are thinking, what you want, and then come with the right solution. We'll be very happy to serve you, sir, individually. Well done, very informative. Thanks, Sundar, for your comments. I think I hope I've answered all the question. Thanks for your time. I think it's been a pretty long session. I think your feedback is very well appreciated. I think it gives us the support. Do reach out to us if you need any material support or any feedback. We will definitely take the feedback of this voice issue which has come up today. My sincere apology, and we'll be very happy to serve investors who has a time frame and the expectation. Thanks once again, and have a great weekend. Let's invest in the right business and make reasonable expected money over a long period of time. Thank you. Arun, we can end the session.
Yes, sir. Thank you all. Thank you all for joining. Thank you, sir.